Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax-efficient or tax-free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no-cost, no-obligation consultation with me. Enjoy. Good morning, everybody. It's just about 10 o'clock on November 30th, Tuesday, November 30th. And this is our weekly webinar. Good to see everyone. Hope everyone had a great Thanksgiving. We enjoyed a few days off at the office here, so that was nice. And we've got a lot to talk about, just like every Tuesday. So I'm going to jump right into it as it's 10 o'clock now. So we do have some holiday hours coming up that I want to tell you about. That our office will be closed the 24th of December through the 31st of December. So that's a week and a day. So everybody getting a much needed break as far as the staff. We're always, of course, available. We'll be checking in periodically. Jessica usually logs in once or twice throughout that week. And then, of course, you do have, if you're a client, you have my cell number if you need something. But if you think you're going to need some money at the end of the year, let's work on getting that done beforehand rather than waiting for that last week, because it can be very difficult to get that done in that last week. All right, so we're going to do our normal routine today, which is we're going to talk about, we got some slot updates. We're going to talk about the markets a bit. So really crazy time last Friday. You know, I was off during the day. I can't remember where we were, but I was checking in on my phone, and, you know, I see the market sliding down just like maybe all of you do or did. And I haven't looked yet to see where we are today. Yesterday was a positive day, but listen, this is how it's going to be, right? We've seen this before. We just have to make sure we have our foundation in place, like we've talked about so many times. So a lot to talk about with the market this week. And then we're going to have our financial planning topic, which this week is going to be QCDs, or qualified charitable distributions. So a really, really great tool that was given to us quite a few years ago now, but it's a really, really valuable tool, and we're going to talk about how it works and go from there. So let's dive into our slot report. So this one is a little complicated. I'm going to try to just skim through it. So this is from Andy Ives, and this talks about the pro rata rule. So let me first explain what the pro rata rule is. So if you have a traditional IRA and you want to do one of these backdoor Roths, which is yes on the chopping block with the new potential tax law, but if you want to do one of these backdoor Roth contributions, many people think, okay, well, I can make my $7,000 contribution into my traditional IRA, have it not be deductible. This is for folks who are over the threshold. And if you're curious what those thresholds are, for Roth contributions or deductibility of IRA contributions, you can go to our website, attleboroughwealth.com. I'll share this with you. I know I do this often, but I think it's helpful. Here's our website, attleboroughwealth.com. Go over to this slot corner, click into there, and then scroll down to the bottom, and you'll see some tables there. And part of that are those tables are, now we're coming to the end of this 2021 retirement planning contribution limits. We're going to update these as soon as they're available. But you'll see here IRA and Roth IRA contribution limits. This is what I'm talking about with the 7,000. But as far as if you're over 50, excuse me, it's $6,000. If you're under 50, most of the folks we work with are over 50. But here are the phase out limits, and this is what I was just talking about. So in 2021, if you're married filing, couple filing jointly, and your adjusted gross income is over $208,000, then you can't make a Roth contribution. There is one exception, and that's if your income is increased because of the Roth conversions. That isn't counted. It's just one little thing that's cut away. So if your income is only $8,000 and you do $200,000 in conversions, you can still make a Roth contribution. So many people don't know that. And for single filers, it's $125,000, $140,000. So if you're over this amount and you cannot make a Roth a Roth contribution. What some people like to do is a backdoor Roth contribution. Now, again, this is a contribution I'm talking about, not a conversion. Anybody can do a conversion, no matter your income at this point. That's also being discussed to limit that. But no matter your income, no matter how much you can convert, anybody can do as much or little as they like in Roth conversions. I'm talking about contributions. So folks that want to make a contribution to a Roth IRA but make too much money, whether they're single or married, they can do this backdoor Roth IRA, and they say to themselves, I can contribute my $6,000 or $7,000, and then immediately I don't get a tax deduction for that. So I immediately, this is now pre-tax or post-tax money, so I immediately convert that to a Roth IRA. No harm, no foul. It's a way to backdoor it, and the IRS has said that's okay. But there is a thing called the pro rata rule. So I'm going to stop sharing here and get back to my notes. And the pro rata rule says, well, wait a minute. If you have $100,000 in an IRA, for example, or any amount of money in a traditional IRA, and you do that contribution, you contribute $7,000 to or $6,000 or $7,000 to your traditional IRA, and then try to convert that now to a Roth IRA, essentially doing a backdoor contribution to that. You have to take a percentage of what's in your IRA, and only that amount of that percentage amount of that $7,000 will be allowed to be tax-free conversion. The rest of it is going to be taxable. So I know it gets confusing, but you have to be careful. We can't recharacterize anymore. So once it's done, it's done, because it is a conversion, not a contribution. It's a backdoor contribution. So I know it's very confusing, as many of these things are. So many people think that you're getting double taxed, and you're really not. That money that you cannot convert, right? So what would that be? I think this is very simple, but yeah. So you'd have to take 7% of the 7,000. So 490. I'm not sure if that math works. I would have to figure it out. But there's a portion that would be tax-free that goes to the Roth, and a portion that would be taxable that would go to the Roth. And then it stays as post-tax money in your IRA and is accounted for. So it gets very confusing, but you're not being taxed twice for it. So this goes on to explain that this person who wrote this is Teddy. Teddy cannot cherry pick only the after-tax funds and then just convert these. Also, it would make no difference if Teddy contributed the $7,000 to a totally different IRA at a different custodian. This is a good point, because some people say, well, if I open up an IRA at Vanguard and I have another one at Fidelity, then if I just contribute the $7,000 to Vanguard and convert it over, then it'll be fine. But the IRS looks at all the IRAs together and aggregates them together. So Andy refers to it as a big bucket of money. So what is the pro rata math on today's Teddy's backdoor Roth conversion? So in this case, Teddy has a SEP or a simple plan. He has no SEP or simple plans. His only IRA is the one that had, in this case, he used 93,000. So let's use Andy's numbers of all pre-tax dollars. Once Teddy contributed the $7,000 or after-tax dollars, his IRA value was $100,000. Makes sense. The total percentage of after-tax dollars was 7%, and the total percentage of pre-tax dollars was 93%. Based on these percentages, pro rata rule dictates that with every withdrawal or conversion will include a proportionate amount or a pro rata amount of pre-tax and after-tax dollars. So Teddy's backdoor Roth conversion of $7,000 is not all after-tax. It is 93% pre-tax and 7% after-tax. So only 7% of that money gets to go over to a Roth and not be taxed. The remainder of that 93% of that $7,000 is going to be taxed. This results in a split of $6,510 taxable income and only $490 of after-tax dollars moving to Teddy's Roth IRA. So then after that conversion, Teddy will have $100,000 in his IRA as follows: $7,000 in a Roth, that is all after-tax money, and $93,000 in a traditional IRA, but that traditional IRA now also contains $6,510 of after-tax basis. Now that is where it can get hairy. If you don't track that $6,510 of after-tax basis and you make a distribution of that money in the future, you could get double tax. That's because you have to keep good records about that. So that goes on to talk about it a little bit. This is a very complicated topic. Just if you want to go down this path and you have a traditional IRA, just be very, very careful. Sometimes it makes sense to send that IRA money to a 401k if you're still working and your 401k accepts funds, because 401ks don't count. Remember, you've heard me say many times that retirement plans like 401ks, 403bs have separate rules than IRAs. So if you want to do this, it may make sense to leave your money in 401ks. All right, so Sarah writes, this came the day after our last webinar, and it was right before Thanksgiving, and I like these. So every year, I think it's Sarah writes these 5 rules that we're thankful for in 2021. So here are 5 IRA rules for which we're thankful. One is portability. So we know that most people change jobs throughout their career. Rollovers for 401ks and IRAs are pretty easy to do. Of course, you can get caught in snafus, just have somebody help you, but most of the big plan providers are really good at helping you manage these rollovers. So this portability means if you leave a company, it doesn't mean that you leave the retirement plan behind. You take your 401k with you, you roll it into an IRA. You know, I've done that. We've all done that. Many of us have done that. You leave a company, you roll it into an IRA or roll it into your new 401k, so you can really, this money is portable. What isn't a good idea is to just leave them all over the place, because a couple things can happen. First of all, you're getting ready to retire and you've got things all over the place. And when they're all over the place, they're usually not managed well. The other thing is, if God forbid you pass, or when you pass and your things are all over, it makes it really, really difficult and challenging for your spouse. You know, we had a client pass away, and well, he actually wasn't a client yet. He was going through the process in July, and we're still pulling things together for his spouse. It's very challenging. The second thing we're thankful for is Roth IRA distributions. The Roth IRA is one of the best tax breaks out there. Boy, isn't that the truth? If you follow the rules, you can take tax-free distributions of years of accumulated earnings. What's not to like for these accounts? We're grateful, Sarah says. The next topic we're going to talk about in depth today, qualified charitable distributions, or QCDs. If you're charitably inclined, we give thanks for QCDs, which encourage gifts to charity by allowing tax-free transfers of IRA funds to charities. We're also grateful for the added benefits of QCDs. They not only decrease the adjusted gross income, but can also satisfy the year's required minimum distribution. That's really great. Number 4 is breaks for spouse beneficiaries. Being married has many benefits, and this is another benefit under the tax code when it comes to IRAs. You have a lot of flexibility of how you can transfer that IRA. You can keep it as a inherited IRA. You can transfer it as your own. It's a lot of flexibility and no tax. So there's such as a spousal IRA contribution, or oh yeah, it's another one, spousal IRA contribution. So if your spouse isn't working and you have earned income and you're below the thresholds, you can make a contribution for your spouse, $6,000 if you're under 50, $1,000 if you're over 50, or $7,000 if you're over 50. That's great. And the ability to do a spousal rollover as beneficiary. And number 5 is Roth IRA conversions. Boy, we do a lot of those, right? A Roth conversion gives an IRA owner the opportunity to trade a tax bill. I like this phrase, actually. The opportunity to trade a tax bill now for the payoff of tax-free earnings in the future. Yeah, I like that. That trading, I like that. With the current low tax rates, this is a deal that many have been eager to take. We are grateful for this strategy. It allows for a more secure retirement by reducing concerns about rising taxes. Boy, that is one of the biggest, you all know, that's one of the biggest risks we have. It's already coming. That window is closing quickly, and we've got to take advantage of it. So I'm glad many of you are. Every year we're adding more and more people to the Roth conversion strategy and tax efficient strategy. As I told you, this year we had a handful of people who were done their Roth conversions, and that's exciting too. So that happens every year as well. So let's talk about the market. So Not many analyst reports. I think the only one I have is BlackRock. So that's good. That's going to give us a little bit more time to talk about the planning. But, it's a holiday week. They're all kind of just getting back. So when I opened up my email box yesterday to start pulling up analyst reports, there weren't many yet. And I looked again this morning, and they all funneled to like a folder I have just for research and webinar prep. But there weren't any that were very interesting anyway, but or many, I should say, but not many generally. So BlackRock just made some key points, and the first one they said is stay invested. So we all know this. You and I, we all know this. But many people get very concerned about investments, especially when they hear about new, new strains, new whatever the word is, that the variants, the new variants, wherever these are coming from. That's what they talked about was driving the market down on Friday. I'm not going to comment on variants or COVID. There are things that are always going to shake the markets. So you've got to stay invested. Of course, you have to have a plan. You have to have your foundation in place. And that's how you get through these things. You stay invested during it. Just as long as your investments are well thought out and they're solid, right? And they fit your plan. And they're maintained, and we do all the things to make sure that they're the best investments available, then you'll be fine. The issue is when people, first of all, don't plan accordingly, don't set up their foundation. They have significant losses in the beginning of their retirement, or sometime, it's most hurtful in the beginning of your retirement, but in the middle of your retirement, it can be devastating too. So it's these unplanned for losses, right? Like that may sound silly, like you're planning for losses in investments. Well, if you're not building your investments with the idea that there are going to be losses along the way, and you're not building your foundation so it's stable and protecting against those losses, you're going to experience them, and then you're going to react, and that's where the trouble begins. So one woman once said to me, how do you adjust for changes in the market? And I said, we don't. We'll make adjustments given changes in your strategy or investment philosophies of the investment managers that we plug into the portfolios. But we know that the markets are going to ebb and flow. Sometimes it's going to be worse than others. But again, if we have that strong foundation, that's what we're built on. So stay invested for now, as the new virus strains and European COVID surge are hurting risk sentiment. Any delay of the powerful restart now means more later. So that's a good point. So BlackRock saying, listen, we've got this powerful restart that's really building. If it gets delayed by other variants, it just means it's going to come on stronger later on. News of contagious new strain triggered a sell-off in risk assets. So that's what we're talking about, mostly stock. Chairman Powell was nominated to stay on as Fed chair. That made some people happy and some people not happy. U.S. job numbers will give investors the latest read on the U.S. labor market that comes this week, a key focus for the Fed after it already reached its inflation target. Boy, that's the tough part right now, right? Inflation of your goods and services, inflation of taxes. That's if we're fortunate enough to have $1 million in your IRA, you first have to worry about how much of it you actually own. So do I own 70% of it? Do I own 80% of it? Do I own 60% of it? And that ownership has to do with your relationship with the IRS. But right now, the average person probably owns 85% of it or 80% of it. That can change really quickly, and it's going to change. And then you have the value of that $1 million as it compares to inflation. So as things get more and more expensive, and we're seeing that very heavy right now, that $1 million is worth less, isn't it? Well, of course it is. Medicare is up 14.5% this year. It still baffles me that that's the first place they went, was increasing those Medicare premiums. There's so many more things they could have done. So let's talk about the markets ending last week. So markets were closed on Thursday, open Friday. The S&P 500 was down 2.18%. The mid-cap market was down 3.17. The Dow Jones Industrial Average was down 1.95. NASDAQ was down 3.52, down really across the board from what I'm looking at here. Even the bond markets were down last week. So some were up, but the aggregate bond index, well, that was up slightly, 0.13%. The global aggregate bond index was down slightly, 0.03. So the Barclays U.S. aggregate index, which is the most widely used bond index, is still down 1.48, call it 1.5% for the year. And the global, so around the world bonds, 4.5%, down 4.5%. So that's where, you know, a lot of investors think I'm going to be safe in my bond investments, and then they get wide-eyed when they're down 4%. So when you're down 4%, inflation is 6%. That's a 10% hit on your spending power, right? That's a big drop. On the positive side, so I gave you the negatives of the markets. The S&P 500 is still up about 24% for the year. That's big. Dow Jones Industrial Average is up just under 16% for the year, and the NASDAQ is up just under 21% for the year. So these are still really good returns for the year. So very positive for sure. Let's just hope we keep it that way for the rest of the year. All right, let me check in to see if there's any questions here before I move on. I do have a question. Gerard, I knew it was it was going to be you. I thought it might be you. So good to see you, Gerard. And thank you for your kind email last week, Gerard. I don't think I had a chance to respond to you yet. So Gerard asked, can you explain the 5-year distribution rules on distributing from Roth IRAs? So the 5-year distribution rule. The rule says that you must own a Roth IRA for a period of 5 years or more for the growth of the investment to be tax-free. As I've said before, the rules are very complex under 59.5. Over 59.5, they get much easier. So under 59.5, each new conversion starts a new clock for the 5-year rule. So you end up with, you know, several different 5-year rules running. But once you cross 59.5, that all goes away. So why is this really a non-issue, or not much of an issue, in my opinion? Is number one, you really have to have your back against the wall to start accessing those funds for the Roth IRA if you're planning it well. If you're over converting, then I don't know what to tell you about that. You should have a better plan, right? Or have a plan. But if you don't, that should be your last money to pull from while you're doing conversions, if that makes sense. It may be a sooner pool of money to pull from after you're done conversions, or to draw from, I should say, a pool of money to pull from. But to draw from after you're done conversions, you might be drawing Roth IRAs before traditional IRAs, and we'll talk about that in a moment with qualified charitable distributions. But the 5-year rule has these ordering rules that the IRS establishes, which says first, any contributions come back to you. So if you've done $100,000 worth of contributions and you need $100,000 from your IRA, that comes back, and that's not taxable. Now the problem is you can't put that back, right? You'd have to redo your contributions. The second is conversion. So any conversions. So if you did $100,000 worth of, say you have a $300,000 Roth IRA, $100,000 is contributions, $100,000 is conversions, $100,000 is growth. So if you need $200,000, well, you take your contributions back, you take your conversions back, and then you're left with just the growth. So that's okay, except for, again, you can't really put that money back. But if you need the growth, my third finger that I'm not going to show you here, my third finger, that is the growth amount. Well, if you're under 59.5 and you haven't had your, or even if you're over 59.5 and you haven't had a Roth IRA for more than 5 years, then you're going to pay tax on that growth part, not on the conversion, not on the contribution, but on the growth part. If you're over 59.5 and you've had even if you had a Roth IRA that's 20 years old, then you had $1,000 in it before you started doing the contributions and conversions, that's fine. So it's hard to get there, is my point. It's staged, right? So I hope that answers your question, Gerard. Good question as always. All right, let's move on, folks, to our financial planning portion. So I'm going to share my screen here. Now, this is a lot of information I'm about to throw up here. So just stay with me. All right. So qualified charitable distributions, or QCDs. We call them QCDs. So what is a qualified charitable distribution? Let me just change my pen here. A qualified charitable distribution is a distribution from an IRA that goes directly to a qualifying charity and is not included in the taxable income of the IRA owner. A QCD cannot be made from an employer plan. This is important. People ask this all the time. Can I make it from my 401k? No. A QCD can be up to $100,000 a year per individual. And a question I get asked is, well, what if my RMD equals 30,000? Can I still do a QCD for 100,000? And the answer is yes. What if I want to do more than 100,000? Can I do that? The answer is yes. You would do $100,000 as a QCD. And then let's say you went to 200,000, and then the other 100,000 would be a regular charitable deduction that would require itemization. All right. So you'd have to itemize on your tax return. You'd have the same rules that we're going to talk about with how much of that is deductible. The QCD, the good news about the QCD is it never passes go, right? You get a 1099, but it doesn't reflect on your, it's not taxable income to you or adjusted gross income to you. Either an IRA owner, this information is directly from the Ed Slott website. Either an IRA owner or beneficiary can do a QCD. The individual must be at least 70 and a half. Now, this is a crazy rule. We know now that RMDs equal 72 now, right? But the Secure Act changed, when the Secure Act changed this to 72, but the QCD rule didn't catch up to that. So you have a period of time when you can still do QCDs, 70 and a half, before you have to start taking your required minimum distributions. A qualified charitable distribution, or QCD, can be made from an IRA, an inactive SEP, or a simple IRA, or a Roth IRA. Why would you want to do a QCD from a Roth IRA? I'm not sure. I don't know. I think there was probably some too many Roth conversions done in that case, and we're going to talk about that in a moment. Only pre-tax amounts can be used for QCD, right? Which makes the use of a Roth funds very unlikely. Yes, the QCD must be a direct transfer to a qualified charity. Direct transfer, very, very important. It doesn't, again, can't take a check. You can't take a check to you as a distribution and then write it to your favorite charity. You have to write the check directly to the charity. A check payable to the charity but sent to the IRA owner will qualify as a QCD, as a check written from a checkbook IRA to a qualifying charity. If an IRA owner receives a check payable to him or her from their IRA and then later gives this fund to charitable, that is not considered a QCD. It has to fall back to the charitable contribution rules, itemized deduction, and you have your limits. Charity must be a qualifying charity. That typically means a 501c3. I don't remember where, I think it looks like that. If I talked about this a moment ago, if a distribution to a charity is more than $100,000, that amount, $100,000 is taxable to the IRA owner and is deductible on the owner's income tax return. The excess amount cannot be carried over to future years. That's a question we often get. Well, if I do $200,000, can I carry over for next year? Can't happen. A qualified charitable distribution can satisfy a required minimum distribution, RMD, but can be made before age 72. So I talked about that a moment ago. So you have this window of time where you can do these qualified charitable distributions even before you have to take your required minimum distribution. They can once you're greater than age 72, they can satisfy required minimum distribution. So if your required minimum distribution is $30,000 and you want to do it, you say, I don't need that money, I want to send it right to charity. You can do that. That satisfies your required minimum distribution, and it doesn't add to your adjusted gross income. So that is a huge benefit. Now, what if you said, well, my RMD is 30,000, right? I'd like to do $10,000 QCD and keep the 20,000 myself. Can you do that? Of course you can. Yep. Your limit is up to 100,000 per person, right? Per individual. So husband and wife, married couple, I should say, can do 200,000. That's really big. That's big. That's a lot of flexibility there. Hopefully they start increasing that, but right now that's still a good number. The IRA custodian has no special tax reporting for QCD. The QCD will be reported on a 1099-R as a regular distribution. The IRA owner will need to report the QCD on his or her tax return. They're very specific. The amount of the QCD is excluded from the owner's taxable income. The IRA owner also cannot take a charitable deduction for the QCD amount. So you can't double dip there. You can't say, well, look, I sent this, right, $100,000 right to the charity, but I also want to deduct it on my tax return. It doesn't work that way, right? This is, if you're going to start embarking on qualified charitable distributions, Roth conversions, you need a qualified CPA, in my opinion. Remember your team. You should have a qualified CFP, certified financial planner. I think that anybody investing their money doing financial planning should work for the certified financial planner. Look, this is the best designation, education, and training that we have in this industry. My opinion, everybody who does this work should work towards that. So you should be working with a certified financial planner. You should have a CPA, and it's, in my opinion, it should be a CPA. And you're also going to need one attorney, right? So you're going to need probably an estate attorney. If you have older parents, or if you're, over 65, let's just say, you should be an elder law attorney, estate. They can usually do the same thing, but you want to have that team in place at a minimum. If you own businesses, real estate, you might have other attorneys. I don't know. But this is the team you want working for you. And believe me, when that's all working together, it works great. And clients of mine can attest to that. When you lose one of these people, I'm going to do that myself. God forbid you try to do that yourself, the attorney. It makes things much more challenging, opens up other risks. It's much more difficult. So work on your team. So we know the Secure Act passed in late 2019, and that increased the required minimum distribution age to age 72. We talked about that already, but the qualified charitable distributions, you can start at age 70 and a half. You must be age 70 and a half. This is not in the year that you turn age 70 and a half. The qualified charitable distribution has to be done after your 70 and a half birthday. I know you don't have birthdays. We used to celebrate half birthdays with our kids. And I think we should start doing that again, because, you don't get enough birthdays with your kids. So start after you turn 70, you can do the same for you. So if you turn 70, on January 1st in 2022, let's just say 6 months and a day later, you can do a qualified charitable distribution if you'd like to. The biggest advantage is, so this came from Investopedia, I think it was. I like the way this Opedia. The adjusted gross income advantage, one of the biggest advantages the QCD rule provides is the ability for taxpayers to lower their adjusted gross income. This is much more valuable, I'm right here, than taking an itemized deduction. And I'm going to show you what that means in a moment from the IRS website. Because adjusted gross income is used for many other tax calculations, however, having a lower number can allow the donor to stay in a lower tax bracket. So it could affect Social Security. It could affect many things. And there's also the amount that can be deducted. If you send $100,000 directly to the charity, you're not paying tax on $100,000, right? That's 100% of that contribution is going right to that charity, and you're not paying tax on it. Well, we know when you itemize deductions for charitable contributions, you have some limits, 50% of your adjusted gross income for most, and it could be 30% for some other organizations. So it eliminates that hassle. It also, as we said before, decreases that adjusted gross income. I said this before, the receiving charity must be a qualified 501c3. So I did that a little backwards. Vehicles such as charitable gift annuities will not qualify. The donation amount must also be substantiated by the charity with a written receipt. Of course, get receipts. Of course. This is a big benefit, and you want to make sure you're documenting it. So why is this important? And why do we use qualified charitable distributions? Because many times what we find is that when we go through, and I'm just going to draw out your buckets. So let's say you have, this is your taxable bucket. This is your tax deferred bucket. This is your tax-free bucket. So we do a lot of work saying, let's just say you have $500,000 here. Let's just say you have $2 million here. And let's just say you've got, I don't know, $25,000 here. So this is Roth, anything tax-free, anything Roth or properly structured cash value life insurance, also known as life insurance retirement plans. So anything over there is tax-free. So many times we're talking about that goal of converting things over either via conversion or via contribution, right? So contributions I like to show up here. Conversions down here. So either via conversions or contributions, we like to move money over here. Now we know there's a couple different things that we want to pay attention to. There's mathematically ideal amounts. First of all, this is 6 months to 1 year of expenses you should have in this bucket, right? Because we don't want this bucket spending off too much dividends, capital gains, interest. What's interest? Interest, etc., because that creates tax, right? Tax dollars. And we don't want too much money building up in your tax deferred, because as this grows, let's say 10 years later, this $2 million becomes $4 million. Well, that's a whopping about $120,000 worth of RMD, right? Required minimum distribution. And you may or may not want that, but you know for sure that you're going to pay tax on it. So, and the tax rate is going to be what? I don't know. But we've done some studies, and we show that the average middle-class American is going to be in the 40 to 45% effective tax rate in the next 10 or 12 years. So we do a lot of work to get this money over here. And let's just say we determine that you can keep $500,000 in the IRA, and your RMDs will be tax-free. And then now you've got $4 million over here in the Roth IRA, and everything's peachy, right? Well, you've done a lot of work along the way, and you've paid some tax along the way. And Sarah said, you know, what was it? A trade-off? I think she said trade-off paying tax now for a higher tax bill in the future. And you've done a lot of good work. So, you know, you've got your $500,000 sitting in here that generates a required minimum distribution now that is below, that would be about $15,000. That is below, less than your standard deduction. So you wouldn't pay tax on that, right? That's a little bit of magic there. But what if you determine through, and then anything that comes out of here, of course, is tax-free, and anything you fund it to Roth is tax-free, and anything you fund it via cash value life insurance or life insurance retirement plan, if it's properly structured, that's tax-free. And if you hit it all, you know, your Social Security can be tax-free. So that's all great. So let's say you did it. You did all the work. You paid your tax. Now you're in that coveted 0% tax bracket. But now wait a minute. What if you're doing your financial planning, as you should do every year, and you determine that, well, geez, I might have several $1 million left at the end of my lifetime, and we call that legacy or longevity money. And we see that. Let's just say you start with $1 million, and we determine that you might have $1 million that you'll never use during your lifetime. Now you want it because there's a couple things. The first thing is, well, what if I need it, right? What if I need it? What if I want it? What if I just want it? What if I just want to do more? What if I want to go to Africa? Well, I guess you don't want to go to Africa right now, but what if I want to go anywhere, right? What if I want to go to Montana? I started watching Tombstone or Yellowstone over the weekend. And I have a friend in Montana, and we're talking about going out there doing fly fishing, and that'll be fun. He's one of my CFP friends, actually. But what if you want to do these things? That's good. So what if you need it? What if you want it? You want it available. But as this also grows, and you go 20 years, 30 years in retirement, this can become a big number. That could become 4 million just in itself. Well, if you have kids, you might say, I don't know if I necessarily want to leave all that to the kids. They may not need it, but maybe you do. And if it's in a Roth IRA or a life insurance policy, you've done them a big favor, right? Because you've taken the tax hit for them, and you've taken it at a much reduced rate. So I use the analogy: if you could buy all the gas you ever needed for the rest of your life last year, you would have done it. That's what you're doing. You're paying your tax now way ahead, right? And you're paying at a much lower discounted rate. So what's my point? Oh, so that's all good. But what if you don't want to give the whole $4,000? Or what if you don't have kids, right? What if you don't have kids? Well, there might be that by identifying what you probably won't need during your lifetime. I get big eyes open when people see this, like, holy cow. So I want it, right? I may want it. I may need it, but what if I don't? And if you don't have kids, or you don't want to leave it all to kids, well, you may have done a lot of work up here in these conversions that you didn't necessarily need to do, because maybe you converted, maybe you could have left $1.5 million in here. Because if you figure out that, let's go back to the million. Maybe you could have left $1 million in here, 1 million. If you figure out that, hey, we're likely not going to use this $1 million, and it's going to go to my favorite charity, or maybe I'm going to create a charity. You can create a charity, and I don't want to get too deep into that, but you can have your family run the charity. So and that's something you'd want to talk to an attorney about. I'm not making a recommendation there. But you could have saved yourself, and if you determine, let me be a little clearer on that. So let's drop this $1 million down. If you determine that this $1 million is likely not going to be used during your lifetime, and it's going to likely go to charity, why in the world would you convert to Roth, right? No. Because if you are not going to pay tax on it, and the charity is never going to pay tax on it, why pay tax on it at all? Why give a Roth IRA to a charity? That is crazy. Doesn't make sense. So you can carve out how much you want to leave to the kids, right? If you don't have kids, how much you want to leave to charity, and you can do it along the way. You don't have to do it with complex trusts and things like that. You can, but with IRAs, you can simply name beneficiaries. And we have this tool called a QCD that we talked about. If you're a married couple, currently you have $200,000 a year that you can send directly to charity, with zero tax. So if you're worried about RMDs, because people say, well, wait a minute, Mark, if I don't convert this $1 million, if we set that aside and it stays in my IRA, that's going to continue to grow. You told me that. That's a concern. It's going to continue to grow. And that's true. And it's going to create a requirement of distribution. And at age 70 and a half, you can start doing QCDs. At age 72, currently, you have RMDs. So if you have $1 million, roughly, that would be $30,000 in RMDs at age 72. If you have $2 million, just double that. It's real easy. $60,000 worth of RMDs. You can send that, if you're charitably inclined, right to the QCD, and just kind of pick at it along the way. So you're not going to pay tax on it. You don't pay tax. And then when you leave this earth, husband and wife, married couple, no kids, or don't want to leave it all to the kids, you name the charity beneficiary, charity A. Oh, and I didn't say this. It doesn't have to all go to one beneficiary, the QCDs. You can identify, I want $33,000 to go to 3 different charities. That's okay. So charity A is your beneficiary. And they get, well, let's use my example, 33 1/3%. Charity B, 33 1/3%. Charity C, 33 1/3%. And the great thing about IRAs is, if you wanted to say, you can even have 3 different IRAs and say charity A gets 100%, charity B gets 100%. So, it's really flexible. There's nothing stopping you from from dividing up different accounts, saying, if you have 3 kids and you have Roth and you want them to receive your Roth IRAs, make it 3 different Roth IRAs. Nothing wrong with that. Or you can have one Roth IRA and divide it up into thirds. A lot of flexibility with beneficiary designations. So while it's important to have an attorney involved, you don't always have to get into complex trust strategies. You can just use beneficiary designations and QCDs. So the power of the QCD is, if I'm not going to move this board again because I don't want it to cut out my screens. If you are charitably inclined for whatever reason, you don't have kids, you don't want to leave it all to your kids. Sometimes we get into big numbers projected at the end of their life. Then you can use this strategy. You can use QCDs along the way, right? So you don't have to commit it all at once. And you can just make beneficiary designations and you can change them. So what if I designated beneficiaries at charity A, B, and C, and I need or want the money? Well, that's okay. You take the money out. Are you going to pay tax on it? Yeah, you are going to pay tax on it if you want it yourself. And you're going to pay tax at a higher rate, but it's there and it's available to you. Now, if you are iffy about it, if you think, well, I don't know if I'm going to want to leave it to charity, then that's a discussion that you want to have about how much to convert to Roth IRA, how much not to convert. It's simple, but it's not easy, as you often hear me say. And that is why, folks, you should do this every single year. Go through this process every single year to determine what your feeling is. I'm thinking of one client in particular. He, out of this couple, likes to change his estate plan often. And he sat back in my office looking at the screen and say, yeah, I don't want to do that anymore. I want to change it this. And he might do that, once every couple of years. So, but you can do that. And the easiest way to do that is with beneficiary designations. All right. So that is QCDs. I hope that was helpful. I do see a question. So let's see here. Oh, really great question, Kathy. QCD is $100,000 per individual, $200,000 per couple. Does each person's QCD come from their specific account? Not all $200,000 can come from one account. Yes, IRAs or individual retirement accounts can't be blended. Good question. All right, great question, Kathy. Thank you. Good seeing you. All right, folks, that's it for today. We'll see you next week. If you have any questions, my calendar is full, I think, until at least the second week of December. As I told you, we are going to be closing the office the week between Christmas and New Year's, starting on starting the afternoon of the 23rd. We're going to have our holiday party on the afternoon of the 23rd. But I look forward to seeing you all next week. We've got some big things coming for 2022. We're going to have David McKnight join us on a Zoom meeting and maybe live. So that's exciting. I'm looking at the end of April to have David come here live. That is a million miles away right now with everything that's going on. So, but at some time in 2022, I want to get him here live. And I'd also like to bring Ed Slott here live in either next year or the following year. But good seeing you all, and I'll talk to you soon. Take care. Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.